early 2000s, the internet is blowing up. Everyone's talking about dot-com companies. The stock market is skyrocketing and investors are making money hand over fist. Fast forward a few years and bam, the bubble bursts. The markets crash and billions of dollars vanish overnight. But that's just the beginning. Over the past 2 decades, the US stock market has gone through some of the wildest, most transformative events in financial history. From the 2008 housing crash to the meme stock frenzy of 2021, and now the AI driven boom that we are seeing today. In this video, we are breaking it all down. Hey everyone, welcome back to the channel. In this video, we are going to talk about how the US stock market shifted from being dominated by traditional industries like oil, automotive, and manufacturing to being almost completely controlled by tech giants. We'll see how retail investors, regular people like you and me, suddenly gained massive power, literally moving markets overnight. And we'll take a closer look at the companies that not only survived economic meltdowns but actually came out stronger. So buckle up because the last 20 years of the US stock market are absolutely insane and the future even more crazier. Oh, and all the information I'm sharing today comes from reputable sources like Investopedia, Yahoo Finance, Federal Reserve, and more. I'll reference them throughout the video, and the links will be in the description. Let's get started. So, let's rewind to the late 90s. The internet was fresh, exciting, and full of promise. Investors were throwing money at any company with a .com in its name. It didn't even matter if the company was profitable. As long as it sounded like the future, it got funding. The rationale was very simple. The internet was poised to revolutionize the world, which it did. Investors were betting on future profits, not present earnings, believing these companies would eventually dominate global markets. According to Wikipedia, by the year 2000, the Nasdaq Composite, an index tracking tech stocks, had skyrocketed from 1,000 points in 1995 to over 5,000 by March 2000. Companies like Pets.com, Webvan, and eToys were soaring despite having little to no profit. This was driven by what economists call speculative investing. Investors were not looking at the profitability, cash flow, or balance sheets. They were simply assuming that if a company was linked to the internet, it was guaranteed to make money. And then it all fell apart. In March 2000, the dot-com bubble burst. Investors finally realized that these companies had little to no profit, just hype. Stock prices plummeted. The Nasdaq lost 78% of its value by October 2002. The key takeaway from the dot-com bubble was hype doesn't sustain a business. Companies need to have actual revenue and a clear path to profitability. But here's the kicker. The companies that survived, like Amazon and eBay, went on to become absolute giants. Amazon stock price, for example, eventually rebounded and crossed $162.85 per share by December 2020. Fast forward a few years. The US economy was booming and housing prices were skyrocketing. Banks were handing out loans to basically anyone, even people with low credit scores. These risky loans, called subprime mortgages, were bundled into something called mortgage backed securities, MBS, and sold to investors. MBS are financial products made up of thousands of individual home loans. Banks sold these to investors as a way to free up cash and to lend more. The idea was simple. As long as homeowners made their mortgage payments, MBS investors would receive steady returns. The problem? Banks started lending to people who couldn't actually afford their loans, assuming housing prices would always rise. When people began defaulting, MBS turned into toxic assets. In 2007, homeowners started defaulting on their loans. Housing prices plummeted. Banks were left holding billions of dollars in worthless mortgage backed securities. And in September 2008, Lehman Brothers, one of the largest investment banks in the US, filed for bankruptcy. The Dow Jones crashed over 14,000 in 2007 to around 6,600 in March 2009. Millions of Americans lost their jobs, homes, and savings. The US economy was on the verge of total collapse. The US government had to step in because of this. The Troubled Asset Relief Program, or TARP, was introduced, pumping $700 billion into the economy to bail out failing banks. Interest rates were slashed, and quantitative easing was introduced to stabilize financial markets. Over the next decade, markets rebounded. Companies that survived the crisis, particularly in tech, saw massive growth. The S&P 500 reached an all-time high by 2013, and the economy entered a new bull market. The stock market has evolved significantly over the last 2 decades. But what comes next? While tech remains dominant, new sectors like artificial intelligence, green energy, and biotechnology are also growing rapidly. Companies investing in AI and automation are attracting lots of investors. And as the global climate policies shift, clean energy firms may soon become market leaders. We're also seeing a growing focus on decentralized finance, DeFi, blockchain technology, and digital assets, which could change how investments work in the future. The markets will continue to evolve while past crashes have shown the risk of speculation. They've also highlighted the potential for long term growth too. So, what do you think? Will the tech dominance continue, or are we on the verge of a new market shift in the market power? Stay tuned for part 3, where we break down what's coming next. I hope you guys enjoyed this video. If you did, please make sure to like and subscribe. Put your thoughts in the comments down below and let me know what do you think about this video and what are your views on the current US stock market and the global stock market frenzy. Thanks a lot, guys, and I'll see you next time.